Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We also have some questions about things like private credits, private markets, what happens next there. So with that as our backdrop, let's talk about the alternative investing landscape. We've got Mike Green with us, portfolio manager and chief strategist at the Alt Strategy RIA, Simplify Asset Management. They offer an array of ETFs and funds. Mike, good to have you here with Tim and me as we have just about 2 hours to go and we wrap up trading here in the United States. Alt investing, some clear winners and losers. What trends do you think might carry into 2026?
Well, I think one of the trends that's been really critical, and it has been introduced with the alternative ETF space, which really didn't emerge until 2020, tied to regulatory changes. Things like managed futures and actually trend following are one of the tools that has made its way over into the ETF space that has been a leading area of interest as people look to diversify from the traditional bond to equity mix. That's one area where I continually emphasize that you're trying not to actually outsmart the market. You're trying to recognize that there's information being diffused that you don't necessarily have at that point. So that trend following is one area. I think other areas that we're seeing increased demand for various forms of income, those take the form of derivative trading, things like call overwriting strategies or put selling strategies that are designed to enhance income. Or it can take the form of things like a hedged high yield credit fund, which is one that I manage at Simplify Asset Management, that is designed to reduce the risk associated with the uncertainty of areas like high yield with credit spreads relatively tight. You want that fixed income exposure and that income generation, but we're really not certain how the economy is going to play out in 2026. Does the slowdown continue or does it reaccelerate? It's a good place to think about, are there ways to protect some of the risks that you have in the portfolio?
So what do you think it's going to do?
I think, unfortunately, I heard you talking about the S&P and the lead-in.
Yeah.
As you know, I've spent a lot of time around
30 year in a row of a bull market.
Yeah, well, actually, I think the most important statistic is if you pull up the statistics that show asset class performance, we're actually now, I believe, in 9 out of the past 10 years that large cap momentum and growth orientation has been the place to be. Unfortunately, as you know, that echoes the work that I do around the impact of passive investing in markets. People are largely shunted into momentum and cap-focused indices by virtue of the way we structure our retirement system in the United States. Unless we see a significant change in the economy, it's just really hard to bet that that's not going to happen yet again.
Yeah, I love that you went there, Mike, because I can't tell you how many years, several years in a row, where people said, momentum trade is over, the big tech, mega caps, done. It's time to go into some of the value names, smaller caps. And yet, here we are a third year in a row.
Girl, you've said this every year for the last 5 years since I've been doing the show with you.
We see the outperformance, but when I look at the economy around me and what impacts my world, a lot of those mega cap names are largely what I spend a lot of time with on a daily basis.
I think there's some truth to that, but I think it also feeds back in both directions, right? Given a very, very low cost of capital, we're seeing the impact that has on the investments that these companies can make. That means that Amazon can go out and make acquisitions, or Google can make the roughly 1,500 acquisitions it's made over the past 7 years. This puts them in front of you, regardless of whether they earned that place initially.
Michael, I keep getting these emails from whatever formerly high yield savings account that I had. I don't know if I can still call them high yield savings account, that tells me that the APR is going down. The yield is going down as a result of the Fed lowering rates and as a result of rates coming down. That money that's in money markets, that's in high yield savings accounts, where is it going?
Well, where we're really seeing that money trend is, one, it continues to grow. So despite the fact that the yields are falling, money market funds continue to hit new highs in terms of assets. That is a byproduct of the money market yield in and of itself. After nearly a decade of roughly zero yields, suddenly people are getting 3 to 5% on those over the past several years. That's created significant additional income, which has meant that money doesn't have to be spent in other areas, particularly for those who are starting with money. The money can't really leave the money market funds, because when you go to buy, somebody else is going to sell and receive the assets as well. Okay. What can happen, and what historically causes those assets to fall, is either the loss of the underlying asset, bonds default, companies go bankrupt, et cetera. That requires injections of cash that take the form of primary securities, or we see a surge in new issuance, things like IPOs, credit for new investment purposes, et cetera. It's that latter part that I think we're actually going to really see in 2026. We continue to see astonishing demand for investment grade debt. Some of it is increasingly questionable how investment grade it is going into areas like data centers. But that is an area where we are continuing to see significant inflows is into the fixed income space.
Well, that's what I wanted to ask you. You know, just going on your website and looking at some of the company ETFs that you guys offer out there, it is an array. It's government, money market, managed futures, volatility, premium focus, high yield, healthcare, Tesla, Volt Tesla, Revolution ETF, energy infrastructure, gold, Bitcoin, China. These are some of the things that we're going to tackle over the next 3 hours. I am curious about, as we were getting near the end of the year, were you guys noticing any interesting trends in terms of flows in and out of some of these spaces, especially after a year where, whether it was gold, whether it was some of the commodities, whether it was, you know, some of the healthcare names and others that may have run up over 2025?
Well, there's a couple of areas, and our growth is largely organic and driven by that innovation. We've seen tremendous inflows into areas like money market funds. We actually introduced a money market ETF in the past year that's powered a significant quantity of growth. Our fixed income strategy, the high yield strategy that I run, has done well and has attracted significant assets over the course of the year. Our other areas in fixed income where we offer differential exposure to coupon yields in things like mortgages, buying new issue mortgages as compared to the seasoned index, that has been a beneficiary. The areas that we've seen that have been, I think, more alternative in their construction, we have a true ESG healthcare fund run by my good friend Mike Taylor. Mike donates all the proceeds associated with that to the Susan G. Komen Foundation. So it's truly giving, it's doing good by doing good. It's performed fantastically well. That area of healthcare is starting to attract attention as technology starts to lose a little bit of its luster. The other area that I mentioned was the managed future space. That is now our largest strategy and has really been a source of continued growth.
All right. Well, hopefully we can continue talking about that, certainly in the new year. Happy New Year, Mike. Thank you so much. Mike Green, Portfolio Manager, Chief Strategist over at Simplify Asset Management, joining us here on this Wednesday.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, so we want to talk a little bit more about retail, more on the trends, the consumption habits, and also the role of technology increasingly that may shape what goes on in the consumer space in the new year. Joining us right now is Laura Champagne. She's Tabor Asset Management's Director of Research and Consumer Sector Head, joining Tim and me right here in studio. Welcome, welcome.
Thanks, Carol. Thanks for having me.
How are you thinking about 2025 when it comes to the retail space?
2025 has been interesting. I think some of the trends like strength in apparel and accessories likely extend into next year. We're excited about GLP-1s moving to oral, not just injectables. So people have to buy new clothes if they're changing sizes.
I was just going to say, what is that doing for retail? But you answered the question right then.
Right.
New clothes, new size.
Exactly. And new clothes may as well have new accessories to go with it. So we're focused in on apparel. We think there are interesting things happening. You mentioned Nike, I think, in an earlier segment. They are desperate and eager to grow again, which puts pressure on Adidas. It puts pressure on Hoka, on running. So I think that'll be an interesting sector to watch these guys duke it out there. We saw so much Nike at Burlington yesterday. In the store? In the store. Burlington had 3 end caps of Nike, and not the weird ones, not the Doritos partnerships.
What does that tell you, that they're offloading stuff that just wasn't selling?
It's a weird time of year, right? So it's a clearance time of year, and it may be that. Or it may be that Nike will grow sales wherever they can, and off-price, the 3 big off-pricers are top 10 footwear retailers now.
Does that dilute the brand at all to be so focused on off-price?
I think it dilutes the brand, and potentially it dilutes the returns. So I think investors are really focused at this moment on sales, them trying to turn sales positive. But margins will be lower. The reason the previous management team focused so much on direct was to maximize profit. We'll see how the market views it next year, but I would guess footwear's less profitable in 2026.
Okay, I want to go back to this thing you said about GLP-1s, because I actually haven't thought about
right?
this at
No,
all.
I
It's very
know.
cool. As a society, are we collectively losing so much weight that we are all changing our closets? We have to all get new clothes. I mean, is that how widespread these GLP-1s are?
You know, as a cynic, I'll tell you that we lose weight and then we gain it back. So most people don't stay on the GLP-1s.
Well, if they don't, this was explained to me. I read this somewhere. The criticism of having to stay on these is like, well, if you stop working out, you get out of shape too. So you have to think about it like that.
Most of the analysts we've talked to on the GLP-1s say that when people stop GLP-1s, they might be eligible again in 9 months.
Do they stop them because they're no longer eligible?
They stop them because they're expensive. So some of the moves that people are making to make these drugs cheaper may help people stay on them longer term. Also, injectable, it's a big deal to shift towards oral, we think.
So don't throw away the clothes because...
That's what I tell my husband. I'm never throwing them out. You never know.
You
might
never know
fit
if
into
you're gonna
it.
need these again.
Hey, the thing though I want to say is that a lot of the GLP-1s are actually for people who are diabetics. And so they tend to stay on them longer or forever because it's in managing the disease unless they ultimately don't need it anymore. But it's also a market where people are losing weight dramatically. And so, that is a big sector of our economy or a big sector of our population.
We also think that apparel is benefiting in part because you mentioned Whirlpool earlier. Big ticket appliances, flooring, those sales are way down. Mattresses trying to turn a corner, furniture too, and we hope they do next year. But since those segments have been down and they've been such a big part of this consumer discretionary budget, it's left room for people to buy more apparel.
I just looked at the credit card statement. My wife not only rejoined Costco today, but put in a big order as well. That's what she's doing. Costco for 2026. Things looking good?
Costco's been losing ground to Walmart, and it's a slightly different customer, although Walmart is gaining with higher income consumers. Costco took tariffs to heart in a serious way, which meant that they had less decor for holiday. I've been in there once again yesterday, a lot less furniture than they usually have this time of year. I think that
So what do you mean they took it to heart? That they didn't plan?
I mean that they canceled orders and they stopped buying some categories that they used to buy. So they had maybe a third as many Christmas trees as they normally would, and are trying to make it up with like baked goods and wine, which they're awesome at. But I think it's tough when you take so many big ticket items out of the store.
Talk to us. Oh, go ahead.
Just still on Costco. I was actually planning out tomorrow, and I was thinking maybe we could actually do our Costco order tomorrow. They're closed on New Year's Day. Is that pretty rare in retail these days?
It's rare in retail, but Costco is
They're an outlier.
where you want to work. Like they pay well, they take holidays, they pay good health care. I mean, recently they started disclosing their regional profit trends. They're barely profitable in the U.S. It's just the membership fees. So anything you can buy from there, you really should. They make most of their money in their international locations.
Looking at Costco, down about 5.5% year to date. Walmart is up almost 24% year to date. What is it that Walmart has kind of figured out? Is it the digital? Is it also kind of playing to a higher end consumer on some level?
It's that, and it's also, and they work hand in hand. So the way they're using tech and AI, a lot of it's the back end, making their deliveries so fast and helping them carry the right products. So better merchandising, they'll deliver to your house. So if you don't enjoy the Walmart shopping experience, you can just wait for the truck. So that's bringing in higher income customers, staying really sharp on prices, being able to watch, real time competitors' prices.
That's where you get your gold bars.
That's where I get my gold bars. Yeah. And I have them delivered. Hey, bring in the truck.
Yep.
Unpack. What's the retail category that you find most interesting right now?
I think beauty is going to have a resurgence. I think that we've been in
I don't know,
this
the
sort of...
Sephora that I go into just outside our office is often packed.
And you should check out
All the
Ulta
time.
when you're not in Manhattan, because they are also packed and
Great
carrying a
Bloomberg
great
Businessweek
assortment.
cover story
Yeah.
just in the last couple of months on this. Amanda Mole wrote about Ulta's success. Remarkable.
And carrying a good mix of beauty, skincare, healthcare, which others, or hair care, which others don't do. Sephora is really focused in on makeup, and Ulta does a great job of carrying like mid-tier brands.
So who are the winners in this space in 2026?
Yeah, we like Ulta. Look for kids, and we're seeing a lot more kids in makeup. Five Below, I think, is a winner. I think Five Below had great price points on
When you
toys.
say kids, are you talking like 8-year-olds?
I'm talking like 8 to 18.
Okay,
So,
okay.
But to
It's
me, I
young.
guess that's kids.
Yeah,
Yeah,
yeah.
I know.
No.
But I do see them in Ulta, and I see them in Five Below, in that kind of lipstick area. And also buying the fake. They had some great fake Kellys yesterday when I was in stores, and of course the Alhambra. They're really good at making it look luxurious for the little kids.
We led talking about Carvana, which has just taken off in a big way this year. eBay was up, Whirlpool, as you mentioned, Best Buy to the downside. Any of those names that you think are worth noting?
Best Buy, we're still concerned about.
Okay.
The data we see does not look great for them. And they got some help with the new gaming systems this year that probably doesn't recur. So Best Buy, once again, Walmart taking consumer electronics very seriously and gaining with a higher income customer. It's not good news for Best Buy.
Give us a big prediction for next year. What happens?
I was going to ask, what's the best day to shop at TJX when they get the new delivery?
I think that Victoria's Secret gets its momentum back next year.
Dana Telsey talked about Victoria's Secret with us, too, that they seem to be going through a redo.
And we don't need them to be massively successful for the stock to work. At their peak, they were selling 45% of all bras and units in the U.S. They're down to 20%, a move up to 25 or 30, new clothes, new sizes, new undergarments.
All right. There it is. That's where we're going to end. That's the prediction. Oh, well, hopefully we see you less than a year from now. But Happy New Year, Laura. Thanks so much for joining us. Laura Champagne is Tabor Asset Management's Director of Research and the Consumer Sector Head.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Gotta say, though, Tim, if I had a nickel for every time I said AI or artificial intelligence,
You'd almost be able to afford a share of NVIDIA?
I would not be here, probably.
Okay.
No, love my job. But you just think about how many times every conversation, even over the last couple of days, as we get ready to wrap up 2025, artificial intelligence, just in our world, there are questions about the spend, the build out, and so on and so forth. But curious to see what our next guest has to say about all of this. Manos Koukoumides, he is CEO of Umi. He previously led the science and engineering for Google Cloud's natural language services while also bootstrapping and leading the Google Cloud Gen AI efforts. He has been working on Gen AI systems since 2016 at Microsoft and then at Meta. Manos, great to have you here on Bloomberg Businessweek and Bloomberg Markets. A reminder that AI has been around for a long time. So I'm curious, when you look at where we are today, how do you put it into perspective and what's kind of the significance of what happened in 2025 after what's been 3 nonstop years of talking about AI and AI investing?
Yeah, Carol and team, thank you very much for having me. As you mentioned, I've been working on AI since 2016, or actually even earlier than that. 2016 was the first time I tried with some of my co-founders at Tumi when we were still at Microsoft to build something like ChatGPT back in 2016. But it was just a little bit premature. And as you mentioned, in the last couple of years has been tremendous progress. It's especially, 2024, 2025, it's been moving forward and advancing at a breakneck speed that it's hard to keep up to and very exciting at the same time.
Do you buy all of the momentum? Do you believe that the spend and the build out is going to continue at this level, or that there's going to be some hiccups, especially when it comes to power, finding the necessary power to keep all of these data centers going?
I think that it's very likely there are going to be some hiccups. As you mentioned, definitely we can build data centers, but it's not enough power to power them, then we can't use them. That's definitely a challenge that is yet to be solved. But if I were to look in 2026, I think a bigger hiccup that I foresee is going to be coming in 2026, or it may be a little bit later. but if it's later, it's going to be only because of the sunk cost fallacy, is some AI bubbles popping. I don't think we're in an AI bubble, but I think there's some companies like OpenAI, Anthropic, and others that increasingly they're going to start looking like the losing horse.
Okay.
And I think they're going to be hiccups in any infrastructure they aspire to build and any funding they aspire to collect.
Yeah, it hasn't been difficult for these companies to raise funding up till now, but you think next year it could be tough?
I think things are going to be getting harder and harder. I think it's about time, and it's already happening. Investors are coming to realize, even though it may be hard for them, because again, of all the sunk costs and all the billions they pour into supporting these companies, that they are actually looking increasingly like the losing horses. I think the code red that OpenAI declared a couple of weeks ago was highly justifiable. There is, a behemoth, a much bigger player that can have all the talent that OpenAI has and much more, that's making $400 billion revenue per year as opposed to losing $10 billion a year.
Okay.
That's in a much better position. It has the full stack across the research, the chips, the models, the applications. It's in a much better position to win this.
We're going to be speaking to Josh. Yeah, we're going to be speaking to Josh Wingrove in just a minute. Before we do that, just set us up for that conversation with where the U.S. is compared to the rest of the world when it comes to this technology and what the U.S. needs to do very briefly in order to be the leader here.
Yeah, so I think we may be doing good now in terms of the closed models, and this is important for us to be doing well, but I think we are missing on the most important AI battleground, and this is open source AI. I foresee looking in 2026, we've been talking to many enterprises from the smallest to the largest ones.
Right.
And one trend that is clear is more and more they're moving towards open models. And unfortunately, this is now primarily by Alibaba's Qwen model as opposed to a US one. So that's, I think, the most important battleground that we need to win. More and more enterprises, as they're maturing with their use of Gen AI, they're moving from large off-the-shelf and differentiated closed models like GPT, Claude, or Gemini that was building at Google. They're more and more moving towards small, specialized custom models that are optimized for the use case. And that's the battleground that AI needs to win.
All right, we shall see. We shall see what 2026 brings when it comes to open versus closed. Manos, thank you so much. Manos Kukoumidis, he is CEO of Umi, joining us right here on Bloomberg.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get a little bit deeper, though, into this media mania. Ross Gerber is with us. He's co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management out there on the West Coast. So good to have you here. Happy New Year to you, Ross.
Yeah, Happy New Year. I'm happy to be spending the last day of the trading year with you guys.
Well, we love our conversations with you, and it's fun to be talking about this with you. I mean, you did join Bloomberg recently, and I just asked Chris about it, this idea about whoever wins Warner Brothers will define the future of Hollywood. Chris made the point that whoever gets it, it's going to be a rough 2026 or 2027 for that company. How do you see it? Talk to us a little bit about this.
Well, Chris used a term that I've used about Warner too, which is called the albatross. And the albatross is, this thing around your neck that constantly driving you nuts and never helps you, right? I think it was Rhyme of the Ancient Mariner where that book was, the albatross was from. But the reality is Warner has never made anybody any money ever since the old days, since Stephen Ross started it, And so every buyer of Warner Brothers has regretted it. And I think the buyer of Warner Brothers here will ultimately regret paying what they're paying for this, because this is really a battle for control of the last piece of asset, on the monopoly board of Hollywood. And it's a pretty good asset, but it's a difficult one at best. And Netflix didn't need it. But the last thing they were going to do is cede all those assets to Paramount and really create a real competitor to them by letting Zaslav and Ellison team up against Netflix. So in the end, now they're they're both paying a ton for it. The Netflix deal is better structured, and it has much lower cost of capital, and it involves stock. And I think it's just a better deal for.
And they're not getting those legacy. They wouldn't be getting the legacy TV networks.
Yeah,
either.
you don't get the legacy cable. The only reason Ellison wants the legacy cable is to shut down CNN's for Trump. And so that's kind of behind the scenes of all this is this battle for CNN. And, the truth is Hastings is a Democrat and Netflix is more of a liberal company. And so, they want to save CNN the way it is and just not be dealing with this. That's not their business. Where Ellison really has more than just money on his mind here. This is about power. And certainly that's where the support from the Trump administration comes for the Ellison bid, is because he wants to kill CNN.
So
go ahead.
Well, Ross, we only have a few minutes, so I want to make sure we get all our questions in. On the Netflix side of things, if Netflix doesn't succeed in getting this, is that seen, in your view, as ultimately a win for shareholders? After all, Netflix shares are lower after making this bid for Warner Brothers Discovery.
I've made a lot of money in Netflix stock over the last decade, and I love the company, and I think it's one of the best assets you could own. But we sold some of our Netflix when this deal went down because the valuation of Netflix is predicated on the business model that they have today. And by buying Warner's, if they succeed, it changes the business model. And I think they deserve a lower PE ratio if they're going to be a traditional studio with all this clunkiness and also lack of clarity of what that future brings. Now, they can make great movies and it's a huge success, or they can make crap and it's a big loss, But we saw what happened at Disney after they absorbed Fox. It was much harder than anybody thought to make this profitable. And now they finally are getting it together. This is years later. So I always thought that Netflix was just bidding it up so that, Ellison would just overpay substantially for this asset and be stuck with it in the end, and then Netflix wins anyways. And that's what ultimately, if Ellison wants the asset, he's going to have to pay $10 billion more for it, and that's the only way Warner Brothers will go for this. And so I do actually expect them to do that at some point. And then if Netflix loses, they really win, and that would bring the stock price back to 120 and all that kind of stuff. But it would also be great for their overall business because they wouldn't have to put all this capital to work at much lower returns.
So, Ross, do you expect one more offer from Paramount, another higher offer, and then that's it? And then Netflix says, I'm out?
Well, I think that, they got, Daddy Ellison to sign off and say, I'll pay for this if my kid actually gets this deal. Not just say I'm going to pay for it, I'm actually going to pay for it. And then secondly, what's another $10 billion to the Ellisons? When you're worth hundreds of billions of dollars, another $10 billion is like, I don't know, a pizza, cost to them. So I think the real issue is they're vastly overpaying for the asset, even at $100 billion. So it's just like $10 billion down the drain that goes to Zaslav. And boy, these payoffs that Zaslav and the executives getting are for hundreds of millions of dollars. So something's going to happen. And I just don't see Ellison going away that easy. And I think Netflix would be satisfied with them vastly overpaying and walking away.
Hey.
But we'll see. I've been wrong. I was wrong about this in the beginning because I didn't think Netflix would bid. But we'll see how badly Netflix really wants to win versus just win the game of business.
Can I ask you, and maybe this is something that's certainly, of course, near and dear to our hearts as we are in the media and news business, and that has changed dramatically over the last 10, 20 years. And I just do wonder how this plays out and what it means for these cable news channels or even these network channels where it does seem like they are being even politicized more than ever. It's not just kind of the venue of cable, but we're now seeing kind of regular linear really being politicized. The problems in that as we think about the importance of news and media in our world. Or is it not so important because everybody's on social media, although that has its problems too?
Right. So where a lot of people are watching your Bloomberg is on YouTube. And I know you guys have a YouTube channel that's very active because I get all these alerts of every time you post my stuff on YouTube. And we all know that media organizations are smart to be reposting stuff on YouTube because that's where people are watching. And by that matter, I'm a big Google investor as well. Yeah. But I think when you look at people my age or below, the way people consume media is 100% different, news media, than my age or above. So my mom is still watching CNN, but nobody I know who is younger watches CNN unless they're in an airport. So that's when I get most of the calls from my friends, is when I'm on CNN, is when they're in the airport. And they're like, oh, I saw you in the airport. And I'm like, wow, that's great. And the other place I'm really popular is in gyms and country clubs where they still watch CNBC or have it on. But in real life, when I'm on a YouTube show, 100 people are like, oh, I saw your YouTube show and da-da-da-da-da. So the world has changed and the media landscape is changing. Cable is dead. It's just a dying thing. So if I'm a news organization, I have to repurpose my content for social media and have 5 or 6 different platforms that I'm putting out my content. And then I'll get the result that I want by having enough views. But just being on cable TV is...
So Russ, we only have 30 seconds left, and then we're going to do some news, and then we'll come back and get more time with you on Tesla. But if that's the case, then what happens if Paramount doesn't get the bid, Netflix does? What happens to the cable assets, very briefly?
Well, it'll be spun off like Versant. And Versant is the Comcast cable assets. And you know, where that goes, where these ships with no future go, I don't know. But it's smart for those companies to jettison those declining yet profitable assets, because in 5 years, maybe less, they'll probably be worth almost nothing. So yeah, I'm sad to say that I don't think people are going to be watching cable TV in 5 and 10 years.
Russ Gerber, we're going to come back to you. We got to leave it there for now because the closing bell is happening soon. Russ Gerber, co-founder, president, CEO of Gerber Kawasaki Wealth Management.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.